You've been careful your entire life. You saved when others spent. You lived below your means. You put money into your 401k for 30 years, watched it grow, and told yourself, when I'm ready, it'll be there. And now it is. You're retired or close to it. The account has a number in it that still surprises you a little when you log in and check. And then something happens. Maybe it's a roof that finally gives out. Maybe it's a second home you've dreamed about your whole life, or a child who needs help, or a medical bill that insurance didn't fully cover. Whatever the reason, you decide to take a large withdrawal. One big pull. Maybe $80,000, maybe $150,000, maybe more. You think, it's my money. I earned it. I'll pay the taxes and move on. But here's what nobody warned you about. That one withdrawal, that single transaction, doesn't just reduce your account balance. It sets off a chain reaction inside a tax and benefit system that most retirees never see coming. It can raise your Medicare premiums for the next 2 years. It can push your Social Security income into a higher tax bracket. It can flag your return for closer scrutiny. And if there's any error, any confusion in how it was reported, any forgotten rollover, any small paperwork mistake, you may not find out until a letter arrives from the IRS months or even years later with a number on it that shocks you. This is the IRS retirement audit trap. And it starts with something that looks, on the surface, completely innocent. Here is the part no one explains clearly enough. The IRS does not audit retirement accounts the way most people imagine. It's not usually someone showing up at your door demanding records. It's quieter than that. It's a computer system called the Discriminant Function System, the DIF, that scores every single tax return in America for statistical anomalies. And one of the most powerful triggers in that system is a sudden large spike in income from retirement distributions. When you take a massive withdrawal from a traditional IRA or 401k, that full amount lands on your tax return as ordinary income. If your normal income is $45,000 a year and suddenly one year shows $195,000, the system notices. The spike is significant, and when spikes are significant, returns get flagged. Not always audited, but flagged. Put in a queue, and if anything else on that return looks even slightly off, the process begins. What makes this particularly dangerous for retirees is that retirement tax returns are genuinely more complex than most people realize. There are 1099-Rs for distributions. There are RMDs, required minimum distributions, that must be taken at the right time and in the right amounts. There are rollovers that look like income unless they're coded correctly. There are Roth conversions, inherited IRAs with their own distribution rules. And any one of those pieces reported incorrectly or mismatched with what a financial institution submitted can open a door you did not want opened. Now let's go layer by layer, because this problem doesn't stop at the audit itself. The year you take that large withdrawal, your taxable income jumps. What you may not fully appreciate is how far that jump travels. The US tax system is progressive, which means different parts of your income are taxed at different rates. When you pull a large sum from a pre-tax retirement account, the top portion of that withdrawal can land in a tax bracket far higher than you're used to. But here's the part that goes beyond income taxes. Medicare uses something called IRMAA, the Income-Related Monthly Adjustment Amount. It's a surcharge added to your Medicare Part B and Part D premiums when your income exceeds certain thresholds. And it's calculated using your tax return from 2 years prior. So if you take a large distribution this year, you will likely pay higher Medicare premiums for 2 full years, starting in the year after next. For a married couple, that IRMAA surcharge can run into thousands of dollars per year. And because it's based on total income, not just your usual income, that single large withdrawal can punch you into a higher IRMAA bracket you never expected to enter. Most retirees don't know this until the Medicare letter arrives. By then, the money is already gone. Here is a fact that genuinely shocks most people who haven't run the numbers. Up to 85% of your Social Security benefits can be taxed. Whether they are and how much depends on what the IRS calls your combined income. That formula adds your adjusted gross income, your non-taxable interest, and half of your Social Security benefits together. When you take a large retirement distribution, your adjusted gross income spikes. That spike can push your combined income well above the threshold, where maximum Social Security taxation kicks in. So you didn't just pay taxes on the withdrawal itself, you also triggered taxes on income you were already receiving, income you had been counting on as part of your fixed monthly budget. Two separate tax consequences from one decision. And if that wasn't enough, take out too much in a single year, and you may also affect your eligibility for certain income based programs, deductions, or credits designed for lower income retirees. The withdrawal gives with one hand and takes away with several others. The IRS generally has 3 years from the date you file a return to audit it. But that window extends to 6 years if the IRS believes income was underreported by more than 25%. And it can extend indefinitely in cases involving fraud or failure to file. When a large withdrawal flags your return and it enters review, the IRS doesn't just look at the withdrawal. They look at the whole return, and then in some cases, they look at prior years. This is where retired couples get devastated in ways that feel completely disproportionate to the original issue. Maybe the withdrawal itself was perfectly reported, but now an agent is reviewing 3 years of returns and notices an inconsistency in how a rollover was coded back in year two, or a required minimum distribution was calculated incorrectly, a simple math error, not fraud, not intent, but still a problem, or an inherited IRA from a deceased parent wasn't distributed on the correct schedule. The IRS finds it. Now you owe back taxes plus interest plus penalties. And here is the cold truth. Retirement account mistakes are one of the IRS's most productive audit categories because the rules are genuinely complex, because financial institutions sometimes make reporting errors, because most retirees are managing these accounts themselves without professional help, and because the amounts involved are often substantial. One letter, one audit, years of records, a tax bill you were not prepared for. Now let me show you two retirees. Same age, similar savings. One decision separates them. Margaret is 68. She needs $120,000 to fund a home renovation and help her daughter through a financial hardship. She goes straight to her traditional IRA and withdraws the full amount in one calendar year. Her normal income is $52,000. That year, her taxable income jumps to $172,000. She climbs into the 22% and briefly touches the 24% bracket on the top portion. Her combined income pushes 85% of her Social Security into taxable territory. 2 years later, her Medicare premiums jump by over $2,400 for the year. And again, the year after that. Her return is flagged. An IRS notice arrives 14 months later about a rollover from 4 years prior. She spends 8 months resolving it, hires a tax professional, and pays several $1,000s in fees and back interest. The $120,000 she needed ended up costing her significantly more. Now look at Robert. Same need, same account size. But Robert sat down with a financial planner first. He split the withdrawal across 2 tax years, $60,000 each December and January, keeping his income below the IRMAA threshold in both years. He also converted a separate portion to a Roth IRA gradually over 3 years, reducing his future required minimum distributions. His returns show no spike, no flag, no notice. He paid taxes on the withdrawals, that part you can't avoid, but he kept his Medicare premiums stable, minimized the Social Security tax hit, and never triggered an audit. Same money, same need, completely different outcome. The difference wasn't luck. It was sequencing. So what do you actually do to protect yourself? First, never take a large retirement withdrawal without modeling the full year income impact before you touch the account. That means looking at your total expected income for the year, Social Security, pension, investment income, part-time work, and then calculating exactly where a distribution will land you in terms of tax brackets, IRMAA thresholds, and Social Security taxation. Run the numbers before, not after. Second, consider splitting large withdrawals across 2 tax years whenever possible. December and January are powerful. 2 smaller amounts often trigger far less tax damage than one large sum. Third, review your 1099-R forms every single year with extreme care. The codes on that form, Box 7 especially, determine how the IRS classifies your distribution. A rollover coded incorrectly looks like taxable income. A Roth conversion coded incorrectly can look like a premature distribution. These errors happen. Check them before you file. Fourth, if you have an inherited IRA from a parent or spouse, know the distribution rules specific to your situation. The Secure Act changed the rules significantly. 10-year distribution requirements now apply in most cases. Missing those distributions or misunderstanding the schedule is one of the most common IRS problems for retirees in their 60s and 70s right now. Fifth, if you are approaching the age when required minimum distributions begin, get a precise calculation. The penalty for failing to take the correct RMD is 25% of the amount you should have withdrawn. That is one of the steepest penalties in the entire tax code. Sixth, if you've already taken a large withdrawal and you're now worried, consider pulling your tax transcripts directly from the IRS website. You can see exactly what they have on file for your returns and compare it to what you filed. Any mismatch is worth resolving proactively before they contact you. And seventh, if you receive any IRS correspondence, any notice at all, do not ignore it. Do not assume it's a mistake and wait. IRS notices have response deadlines. Missed deadlines escalate the problem. Even a letter that turns out to be minor requires a timely written response. Here is the final truth you need to carry with you. The money inside your retirement accounts is yours. You earned it. You deferred it. You watched it grow through market crashes and recoveries and decades of work. No one is trying to take it from you. But the system surrounding that money, the tax code, the Medicare rules, the IRS matching algorithms, was built in layers of complexity that most retirees were never taught to navigate. And that complexity becomes a minefield the moment you make a large, unplanned withdrawal, not because you did anything dishonest, but because the system has teeth, and it bites hardest at the moments when you're simply trying to use what you saved. One large withdrawal can change your tax bracket, your Medicare costs, your Social Security tax burden, and your audit exposure, all in a single year. That's not a scare tactic. That's the math. The retirees who come out whole are the ones who plan the withdrawal before they make it, who understand the threshold numbers, who check the forms, who don't assume that because they've been paying taxes for 50 years, they automatically understand how retirement account taxation works. Because it's different, it's more complex, and the IRS knows it. If this gave you something to think about, save this video, come back to it before you make any large financial move. And if you have a spouse, a sibling, a friend who's thinking about pulling from their retirement savings, send it to them now before they make the move that can't be undone. Subscribe if you want to keep getting these warnings, because the traps ahead of retirement are real and most of them are invisible until it's too late. Stay protected, stay informed, and don't let a single transaction undo 30 years of discipline.